So my goal here is to give you a basic understanding, so it's not an advanced, super duper high level, but it's still a pretty good understanding of what a managed account is, and explain the difference of a mutual fund and a managed account so that you understand, and to give you some advantages of using a managed account with the right client over mutual funds. Because remember, mutual funds are great, right? Mutual funds are great. So let's start with who we have. We have 11 different asset managers. That's what they call them. So rather than a mutual fund company, they're called asset managers. So we have 11 different asset managers that between them have 101 strategies. So we have 101 different strategies that we could use with clients in the managed account space, which is pretty good. Way back, we had like 5. Remember that with like Lockwood, right? Now we're up to 101. Here's the managers, and you probably won't recognize all of them, but you'll recognize some of them, like Morningstar. You're like, Morningstar's an asset manager? Yeah. So you got Morningstar, Invesco, RNC, Genter, Meter, Dana, Sage, Horizons, Natixis, Franklin Templeton, Lockwood, and AGF. And the lineup's pretty stellar. Now, you're like, I don't know all those names, because you don't know managed accounts, because that's a small niche. I mean, it's not small anymore. It's huge, but the average person is not involved with managed accounts. These are all huge, reputable names. We chose what we thought was the best of the best. Gives us 101 strategies, really spreads it out pretty good. 29 of them are SMAs. What is an SMA, everybody? Separately managed account. What does that mean? That means when you own a mutual fund, you own a share of the mutual fund. So you don't own the stocks. The mutual fund company owns the stocks, and you own a share of the mutual fund. That's why you could buy 0.128 of a share. That's why you can invest for as little as $25 a month, is you're not owning the actual stocks, you're owning a share of the mutual fund. In the SMAs, you actually own the stocks. Separately managed account. You have your own portfolio with your own stocks in there. That's why there's minimums, because if in their strategy they own 50 stocks, you've got to be able to invest enough money so they could purchase adequate amount of each one of those 50 stocks. Okay, so you can't buy like 0.128 of a share in an SMA. So you own the stocks or the bonds. And that's next level investing. I would call mutual funds as like introductory, intermediate investing, where you're reaping the reward of the market, but you don't know what's really going on in the mutual fund. Like when you own a managed account, every time they make a trade, you know they made a trade. You could log on to your account and they'll tell you, today they unloaded this stock and they purchased this stock. Today you got this much in dividends and it was reinvested in this stock. It's real time. It's like you feel like, shoot, I got my own private money manager that's just running my money versus a mutual fund. That's the difference there. The rest of the strategies use ETFs and mutual funds, and again, or a combination of ETFs and mutual funds, okay? And the mutual funds, as I went out, I brought up already, are institutional class shares with no loads and lower expenses. I'm going to give you an example of a mutual fund versus a managed account with the exact strategy. So let me give you this explanation. We're going to look at the ClearBridge Aggressive Growth Mutual Fund and the ClearBridge Multi-Cap Growth Fund. The charges work like this. The operating expense on the mutual fund is 1.13. 3. That's their operating expense. That's what it costs a year to run. So whatever you have in there, they're going to charge you 1.13. A managed account is not just one expense number. It's added 3 numbers, put in a 1. One of them is the advisor fee, one is the administration fee, and one is the asset manager fee. So the advisor fee is what we charge. Okay, so when you're licensed, you charge an advisor fee. Whatever fee, pretty much, there's a range, and you charge whatever you want within that range. It's really like weird, because we're used to, with mutual funds, we don't control that, right? But with this, we do. So let's just say at $1 million, you could charge from 0.5 point to 1 point as the advisor charge, right? So let's use $1 million example, and I will here. And then the admin fee, so the advisor fee is for the advisor. So we run our managed accounts on the TD Ameritrade platform, so they're going to get statements at their house from TD Ameritrade. You're like, wait a minute, ain't I with Primerica? Yeah, but we hire TD Ameritrade to do all that stuff. It's less money for us to hire them to do it than we do it in-house. So we hire TD. So it really kind of gives us credibility, like, hey, we do business with TD because everybody knows them. And then the manager fee is what ClearBridge would make. So ClearBridge gets paid, the administrator gets paid, the advisor gets paid. When you add all those up, that's your total expense. So on $1 million, I worked out $1 million because the larger the amount is, the more likely you are to use the managed account. The smaller the account is, the smarter it is usually to use the mutual fund. So at $1 million in the ClearBridge Aggressive Growth Mutual Fund, there's no load. But remember, there's a 1% charge if you withdraw money over 18 months. In the managed account, no load. You could withdraw it next week if you wanted to, no charge. The advisor fee ranges from 0.5 to 1%. In a mutual fund, let's talk advantages here. Transparency. If a client really wants transparency, the managed account is the most transparent. That 1.18 charge is what you pay, period. There is no other charge. In a mutual fund, even though it tells you it's 1.13, and you got to read all this stuff, it was hard to look this stuff up. But trading expenses are not included in the mutual fund's operating expenses. The reality is most mutual funds, I don't know if there's a small number of them that don't, but the majority of them do not charge their trading expenses. What it costs them to buy stocks every day, sell stocks every day is not included in their operating expenses. So that 1.13 maybe isn't 1.13. That trading expense could range from 0.1 to 1%. Depending on how often they buy and sell and stuff, right? So even if it's 0.1 on the low end, now you're at 1.23 versus 1.18. But it looks cheaper because that one cost is actually taken off the NAV price, and it's not transparent. They're not trying to hide it, but they just can't put it anywhere because it's a variable cost. They don't know what it's going to be. They don't know what kind of discounts they'll get because the more they trade, they get volume discounts. It's very tricky. But here, you know exactly what they're charging you. Let's move up to flexibility. Because there's no charge up front, no load up front, you could use multiple managers. Like with mutual funds, you pretty much need to use one investment company because you'll be paying more loads because you'll miss out on break points and discounts. Here, there's no load up front, so you can use multiple managers. You can use up to 3 money managers in each one account if you wanted to. Okay? So that's good. So, and if you're not happy with their rates of return, you can move the money. If it's in a qualified plan, you can move it all day long. Not that we recommend do that, but you can with no charges. So that's pretty good. Taxes would apply if it was non-qualified and you're moving it around, but if it's qualified, you can move it around without so. This is a guide that they give you as the advisor that you charge. So let me give you an example here. Let me zoom this in. The advisor fee, it's not what they charge, it's a guide. The advisor fee. The rest is a locked-in fee. So the administration fee, you notice the more you invest, the lower the admin charge goes, right? So if you got $10 million, it's 0.20. If you have from 0 to 250, it's 0.49. The advisor fee, this is the recommendation, but when you click on it, it'll give you the range. So like with the 0 to 250, when I clicked on it, the range was 0.80 to 1.25. So home office's recommendation is 1%, but you could charge up to 1.25%, or you can charge 0.80%. It's whatever you're comfortable with charging. I will tell you this, most of these charge 2% all in. I've looked around the industry. So if you're charging less than 2, you know, you're competitive. So the more they invest, the less the advisor fee range is, right? So you make less, but you make it on volume and on and on and on. So this is there. That's pretty cool. And then the admin fee, I mean, not the admin fee, the operation fees. I know this looks crazy, and I'm going to zoom in on it. So here, as an example, I'm using the ClearBridge multi-cap growth that's highlighted, and the fee is 0.30. Remember, on the mutual fund, it's 1.13. The management fee here is 0.30. When you add in the admin charge and the advisor fee, it adds up. So let me show you more about this. Again, this is like, you know, to wet your whistle about, like, man, maybe I should get this licensed. So if you look here, and I'll take this thing out, tax benefits doesn't apply to qualified accounts, but for non-qualified accounts, it's a big deal. Let me explain this. This is important. When you buy a mutual fund, you are buying their cost basis. So if you buy the Legg Mason or the ClearBridge Aggressive Growth Fund, and it's $129 a share, you're buying that $129 share. There's already capital gains embedded in there. What do you mean, Omar? I don't understand. In that $128 price, he owns stocks. Let's just say United Healthcare. He owns United Healthcare, and it's probably worth $180 now. His cost is probably $80. So there's $100 capital gains there that when he unloads it, whenever that is, you're going to split the taxes. You're going to pay everybody else's taxes with that gain, even though you didn't reap the reward of the gain. I don't know if I lost you there, but when you buy that aggressive growth fund, you're buying their cost basis. So if you buy the mutual fund today, but in the mutual fund, that United Healthcare stock is already at $180 and their average price was $80, there's a $100 gain there that you did not get the reward of because you're buying in at that price. But when they unload it and they create that capital gain gets spread out through all the holders of the mutual fund, so you'll get a capital gain for growth you didn't really get. Okay, you're like, whoa, I don't know. That's for non-qualified money, not for qualified money. Okay, I just want you to explain it. If you own the managed account and you invest in it, he's going to use your money and purchase every stock, and you're going to get your own cost basis. So you're buying, in that example, the United Healthcare stock at 180. So if he unloads it the next week at 181, you're only taxed on $1 capital gain versus the $100. You get that? That's a big deal. Now, most of our clients are in IRA accounts. Most of our smaller clients can't invest in a managed account anyways. So even though that benefit is there for the managed account, there's not a better place that a small investor could invest other than mutual funds. So I don't want you, oh man, mutual funds suck. No, they're great. We've already went over that, right? Mutual funds are great, right? Mutual funds are great, right? And for the right client, managed accounts are great for the right client. High net worth clients, 200,000. I look at it, 250 and above is where I'm going to start looking for managed accounts. Why? Because at 250 and above, you can now start, $250,000 and above, a little bit less here, a little bit less here, gets them a little bit less on the total cost, and it could work out better for them, right? Now, okay, so tax benefits. So let's get to this. The other thing, you're not at the mercy of other people's distress. What do I mean? Last year, COVID happened. Market went down. If you owned aggressive growth fund or any mutual fund, non-qualified, I'm not talking IRAs, non-qualified, and other people got scared and wanted to liquidate, that money manager has to unload stocks that he probably doesn't want to unload. He has no choice because he's got redemption requests, so he has to unload stocks. If he's unloading stocks that have those deep capital gains embedded in them, you're going to get at the end of the year a 1099-R. What's this? I got how much in capital gains? I learned about this years back because when you've got enough money, when it's small accounts, you don't realize it. When your accounts start getting large in non-qualified, and you're looking at your year-end statements, and you're looking at your capital gains, and you're like, what? Managed accounts is more tax efficient in a non-qual. In an IRA, doesn't matter. But in non-qual, it's more tax efficient. So let's look at this also. In the aggressive growth fund, as of 8/31, because that's the last we could get from it, because remember, mutual funds release like a month after, right? You never know what's in your mutual fund at the present time. That's proprietary, they say. We don't want anybody else to know our strategy, so we don't tell anybody what's in. And after the quarter's done, then we'll release what was in our fund for the last quarter, but you don't know what's in there now. Again, for the little guy, for the middle income guy, there's no greater investment than mutual funds. I'm just telling you why we're getting into the managed account fund, because Primerica's, it used to be Primerica would get like $1 million trade once a month or something like that. Now we get $1 million trades every day almost, right? Dozens a day. So we had to adapt. All right, listen, we're getting dozens a day. You're like, I want to get one of those. Well, you better get a managed account license. But annuities are also flowing the huge accounts too. Big trades, right, in there. Big IRA rollovers in mutual funds too, because remember, Class A, no load. So let's look at this. We have on the left side the mutual fund, on the right side the managed account. On the left side, the mutual fund has a lot of rules. Because remember, the regulators know that middle income America really uses a lot of mutual funds, and we need to watch over those people. We need to protect them because they don't know any better. This is their philosophies. So there's rules on mutual funds that are not rules on managed accounts. So like in a mutual fund, you can only own one stock, X percentage of the overall portfolio. So let's say Richie only likes 35 stocks, but he's already capped out at the maximum amount of that stock he can own. He now has to go out and look for other companies, even though he really doesn't want to. He likes these. He'd rather invest more money into these rather than go out looking. But in a mutual fund, you got rules, and the rules are the rules, and you got to do the rules. So in the aggressive growth fund, Class A, as of the end of August, he had 48 holdings. As of October 1, which was yesterday, right, how did I know how many holdings there were? I logged on to the account and said, how many stocks are in my portfolio right now? 35. 35, 40, that's 13 stocks difference. That's so in the managed account space, he could look at his mutual fund holdings and say, man, I really like these 35. These, I like them, but I really had to buy them. I didn't really want to buy them. These I love. I can own those. Has more flexibility in it. So it's more aggressive though, isn't it? More risky, right? So if you want less risk, you use the ones with the ETFs and the mutual funds. If you're more aggressive, remember earlier, I said I'm aggressive. Plus, this is only one account. If you had 3 accounts and you have probably 120 stocks. So look at the difference. Now, I'm going to give you number 5. I'm not done explaining some stuff. Let's keep looking at number 4. So what I wanted to do is I wanted to give you a comparison. Now that we've seen the differences, let's look at the returns, right? Let me cover this so you don't read ahead. So I'm going to show you $10,000. I know you can't use a managed account with $10,000. There's a minimum. A couple of them will let you do $25,000. Most of them are $50,000. If you're in a bond fund taxable, the minimum's $150,000. If you're in a municipal, the minimum's $250,000. So again, like you're like, man, I want to get my client. Oh, my client's got $100 a month. He's going in a mutual fund. Nothing's wrong with a mutual fund. This for bigger money. That's all. So let's just make believe that you could do a managed account for $10,000. Why did I want to do 10? In a mutual fund, you're going to have the maximum load with the operating expense. When the managed accounts give you the returns, they give you the gross return with no expenses, and then their rule is they've got to give you the return with the maximum expenses because they don't know if the advisor's charging less or not, so they got to let you look at it with the maximum. So I wanted to look at apples and apples, the maximum with the mutual fund, the maximum with the managed account, okay? If that should all make logical sense after my training today. If I would have explained that this morning, maybe not, but at this point, you'd be like, I got that. So, $10,000 right here in the aggressive growth fund. I ran it for 25 years, ending June 30th, 2021. So for 25 years, it averaged 10.89% net of fees, which means it grew from 10,000 to 132, so it grew 13 times. Would any client be angry with you if you grew their money 13 times? No. The managed account multi-cap growth, which is what it's called, the gross rate was 14.26. Remember, it's pretty much the exact fund, only Richie's not limited to all those rules, so he could invest a little bit more aggressively and own the stocks that he likes and not the ones that he was required to buy. You with me? So the gross rate was 14.26. The net return with the maximum fees was 12%. Figure you could lower the maximum fees a lot because the maximum fees on the smaller amount was 1.99. We could lower it to 1.18. So what's that difference? 0.8 difference? Do 0.8 of a difference over 25 years. It's a big difference. But let's look at apples and apples, right? Maximum and maximum. 12 was the net. The max cost, and the Russell, which is what it's measured against. The aggressive growth is measured against the Russell. So the Russell index with no cost averaged 10.02. So the mutual fund beat the index. So it did its job net of fees, beat the index, and the managed account beat the index by 2 points with the maximum charges. So really, without the maximum charges, you're looking at 2.5 to 2.8. It beat the index. Pretty stellar. This is the maximum charge, 1.25 advisor fee, 0.49 admin fee, 0.30 manager fee, 2.04 versus what was it I said was 1.18 with the lowest fee, so it's almost a point difference. So now I ran the numbers with $1 million. The $1 million in the mutual fund, remember, now there's no load with the $1 million in the mutual fund for that exact period with no charge, the net return is 11.15 versus 10.89%. So it's a small difference, but over time, it's a lot of money. So let me show you what I'm talking about here, so that you know that I'm not, stretching the truth here. This is the actual managed account fact card that you get, and it tells you the multi-cap growth, the gross rate. This is the pure gross rate, which means no expenses, 14.26, and with the net using the maximum, because they always use the maximum, 12% even. So it's pretty cool. So when I looked at the difference, I looked at $1 million now, so that you could charge the lowest on the Class A mutual fund and the lowest on the managed. And the difference is $1 million, bottom line, it made 12%. No, that's with the max charge, remember? So 12 with the max charge versus their minimum charge with no load, it's still $500,000 more money in the managed account. And if you charged the minimum on the managed account, I bet you it's closer to $1 million difference. What we do, nobody does. I'm telling you, nobody does what we do. And Primerica, especially, the whole company, on the life side, they're working on this new life product. It's going to revolutionize everything. It's going to be unbelievable. They're going to roll that out. The investment side, they added managed accounts. They added the different annuity companies. They added more mutual fund companies on the platform this last year. On the mortgage side, we do the Rocket Mortgage deal, the #1 lender in the USA, or the number one or number 2 lender in the USA. For the last 12 years, they do all this advertising. You walk in, you say Rocket Mortgage, oh yeah, here, write me up. We just purchased a new health care company for seniors that we bought the company. $650 million, I think it costs. You imagine? Yeah, 650. How much? 650? Yeah, sure, no problem. $650 million. We got all the resources available to us for licensing. PFSU, free, $99 IBA, pays for your life and investment licenses. I know we only use the life part of it, but we need to get more people investment licensed. Guys, listen, man. There is no company like Primerica. There's not. Listen, it's true.